as we move to the next slide, I have a few housekeeping things that I want to get through. So Opus Connect, we are a lower middle and middle market M&A focused organization. We cater to investment banks, lenders, private equity firms, independent sponsors. We are membership based. We have chapters in LA, Chicago, and New York, where we hold monthly seminars. And in addition to those, we do deal sourcing events all around the country, also in Canada as well. So if you're interested in learning a little bit more about Opus Connect, my name is Lena Dobrier. I'm Director of Operations. You can reach out to myself or my colleague. His information is down below, and he'll be happy to address any questions that you may have. As we move to the next slide here, there is a Q&A at the bottom where you can ask your questions. So as the panelists move through the discussion and you have questions, feel free to type those in there. We will monitor those. We will take them live if it works, or if not, we will have 10 to 15 minutes at the end dedicated to that. So again, enter your questions there and we'll try to get to as many as we can. Before we begin the discussion, these events would not be possible without the support of our sponsors and our hosts. So I definitely want to give them an opportunity to introduce themselves. I'm going to start with Plexus, and Robert, I see you here. I'm going to go ahead and unmute you. Please introduce yourself and your firm. Are you there, Robert? Remy? Okay, we can't hear you. We'll move on to the next sponsor, but we definitely want to acknowledge Plexus, and we'll come back to you. Sapient Investigations, David Kogan, I see you here. Please introduce yourself and your firm.
Good morning, Lena.
Good morning.
My name is David Kogan. I'm the Managing Director of Sapient Investigations. We're an international corporate intelligence firm, and always happy to be here. Of course, we specialize in integrity work, so we do all the background checks. We do a lot of background checks for the private equity industry. We vet executives, board members, joint venture partners. We also work with the lending industry and do a lot of large commercial guarantors. So we are kind of a one-stop shop for all human intelligence. We also have a very robust litigation practice. So any business disputes of any nature and internal investigations, we do a lot of those as well. So of course, it's always nice to be here. We've been with Opus for almost the entire 10 years. And I'm looking forward to an interesting webinar.
Thank you, David. Moving on to our next sponsor, 4 Degrees, Ablorde. I see you here. I'm going to go ahead and unmute you. Please introduce yourself and your firm.
Great. Hi, everyone. You have Ablorde here. I'm the co-founder and CEO of 4 Degrees, Chicago-based technology company. Think of us as both a deal flow and relationship intelligence solution built for the private markets. So today we work with customers across the private equity, M&A, and investment banking spectrum. And what we do is automate and data entry about your team's relationship network with a bunch of actionable intelligence to leverage that network for your advantage. And so that's everything from automatically tracking the set of folks your team are interacting with the last time you spoke with them, giving you recurring reminders to engage with key deal flow sources. So think of those as sponsors or lenders or other service providers, and then giving you some of that intelligence that I described. So detecting travel from your calendar, at least post-COVID-19, and sending you a list of relationships that live in the destination city, detecting deals done by capital providers that you know, and a bunch more information along those lines. So happy to be here with you and answer any questions that you have. Thanks.
Thank you, Ablorde. Moving on to our next sponsor, Focus Search Partners. Steve, I see you. Please introduce yourself and your firm.
Hi, thanks, Lena. Pleased to be here. I'm Steve Finder with Focus Search Partners. Think of us as 2 arms. We've got an executive search division focused on healthcare, technology, and industrial. We also have a consulting arm that focuses on the office of the CEO, helping companies become more streamlined and financially and operationally efficient. So kind of 2 sides. And pleased to be here, and thanks for having me.
Thank you, Steve. I don't believe I see Nick in here from Resourcive, but I do want to acknowledge them. Absolutely. They are a newer sponsor, and we're happy to have them on board. You can see a little bit about them here or go to their website if you're interested in learning more. I want to briefly go back to Robert or Rami. I'm gonna go ahead and unmute you one more time and see if you're there. Robert, are you there and able to introduce yourself and your firm?
I hope so. Can you hear me now?
Yes.
Yes. Well, that's Rami on the screen. That's me. I'm Robert Stride. I'm married to Rami. Rami and I have been working in insurance together for 5 years, but we didn't come from the insurance industry. Rami was a healthcare M&A banker at Lehman Brothers in New York, and then she also worked in leveraged finance at a couple of different shops working with sponsors. I was a corporate attorney for 17 years before making the jump to insurance. And essentially, we are insurance consultants that help shape and restructure insurance programs using a variety of different exclusive facilities, as well as management and consulting techniques to basically help right-size the programs, keep them as cheap as possible, while also protecting the personal assets of a lot of the officers and directors.
Awesome. Thank you so much, Robert. We're happy to have you here with us today. So before we get to the good stuff, while you're all here, we have a few audience poll questions. We'll try to move those quickly. These are helpful for us internally to understand how you heard about today's event and who you are. So we launched that first one there. We want to know how you heard about this event. Was it through us, a speaker, a sponsor, LinkedIn? How are our marketing efforts going here? We'll give you about 10 more seconds to participate in that, and then we'll move on to the next one. Great. A lot of you heard from us, a few from our speakers and our sponsors, so thank you guys again for your support. We'll move on to the next question here. This is helpful for us, but it's also really helpful for our panelists to understand who's in the audience today, who they're speaking to, and can kind of help drive that discussion to make it relevant for you. So please participate in this last poll question, and then we'll get to the good stuff. Give it about 5 more seconds here, and then we'll end and share the results. It looks like many investment bankers, which is great. I'm sure many of you are participating in our Deal Connect directly following, a few independent sponsors, capital providers. That's great. And I just want to make one clarification here, and I apologize. It looks like we had the incorrect title on the first slide here, but today we're going to be discussing healthcare services and M&A and why it's vital to have strong acquisition and capital pipelines. So without further ado, I'm going to kick it over to our moderator today, a longtime supporter and friend of Opus Connect, Larry Simon of Clearview Capital. Larry, take it away.
Thank you, Lena. I'm Larry Simon. I'm a partner with Clearview Capital, a private equity group based in Connecticut. I run the Los Angeles office. We're currently managing Fund 4, a $550 million fund. And throughout our history, we've invested in over half a dozen private equity platforms and many add-on acquisitions. So I have some experience here in healthcare services. Today's title and topic is Healthcare Services, M&A. Why is it vital to have a strong acquisition and capital pipeline? Some of the areas we'll cover are that healthcare service businesses are an important part and a growing cross-section of transactions in the economy and the middle market. Given the current pandemic, the panel will discuss challenges, trends, and opportunities in healthcare services. We'll cover which specific areas have found the most benefit for the consumer, patient, and client, and which have become the most challenged. How have new lines of business, treatments, and technologies all led to the need for a strong deal and capital pipeline? And where is the current market for acquisitions and capitals, and where are deals happening, which sectors are they happening in? Today, my panelists are Dan McIntosh from BMO Capital Markets, Healthcare M&A. I'll let Dan introduce himself.
Dan, you're muted. There we go.
There we go. So again, this is Dan McIntosh with BMO's Healthcare M&A team. I'm based out of Minneapolis. I've been here a little over 3 years, and my time is probably spent about 75% on healthcare services, and the rest on devices and manufacturing. Within healthcare services, two main focus areas are behavioral health and then kind of the broader retail or consumer-directed healthcare space. Before this, I was in a private equity consulting role with Alvarez and Marsal out of New York. Before that, I worked at Baird in Milwaukee, and previous to that was with GE Healthcare, where I started my career, which was also in Milwaukee. And then just as far as my team at BMO, again, out of Minneapolis office, we focus on the middle market, have about 25 professionals. More broadly, BMO also has M&A teams in Chicago and New York. And then we've also got a broader healthcare coverage team based in New York with focuses on life sciences, specialty pharma, and then of course, healthcare services.
Great, thanks, Dan. Next, we have Dan Schultz from Webster Capital, a private equity group also specializing in healthcare services.
Hi, my name is Dan Schultz. I'm the Vice President of Business Development at Webster Equity Partners. We're a $875 million fund based out of Boston. Our focus is healthcare services and branded consumer. Within the healthcare services perspective, we're doing home health and hospice, physician practice management, behavioral health, specialty pharma, life sciences, and healthcare staffing. So anything that touches the healthcare facilities on a services base is where we're going to be looking to invest money.
Thank you, Dan. And next we have Ken Benton from Ziegler Healthcare Corporate Finance.
Yeah, thank you very much, Larry. Yes, Ziegler in our healthcare services group, we've got about 35 to 40 professionals. I'm based out of the Minneapolis office, but we have professionals actually out of 5 offices around the country, focusing on some of the same areas that have been mentioned, but physician practices, behavioral health, telemedicine, managed care, and then home health and hospice is a pretty big focus of my team in Minneapolis in particular. I personally been doing healthcare investment banking for the last 10 or so years. Joined Ziegler about 2.5 years ago. So very happy to be part of this panel and look forward to it.
Thank you, Ken. So why don't we jump into our first question? Given we've talked about some sectors already, what are the sectors of strength in the healthcare services side that you all are seeing or working on? Why don't we start with Dan McIntosh from BMO?
Yeah, thanks, Larry. So one of the main areas that we're seeing higher demand right now is in behavioral health. We're seeing it in a couple of sectors, in behavioral in particular, the first being in mental health. I'm sure we're all seeing similar headlines with that, with demand that's increasing as folks are dealing with concerns about job loss, economic uncertainty, sometimes just with getting food, or else with the fear of getting sick from the virus or having their loved ones get sick. The second area in behavioral that we're seeing strength is in addiction treatment for a lot of the same reasons as for mental health, except that in these cases, people are resorting to alcohol and other drugs and need to get help. Within addiction treatment, we're hearing of higher census levels and higher occupancy rates versus the pre-COVID period. And that's been applying to both in-network and out-of-network facilities. It's also across the continuum of care. So from inpatient and residential to outpatient, and that includes both intensive outpatient and partial hospitalization. And then aside from behavioral health, another area that's seeing a lot of demand and activity is in healthcare IT, in particular in telehealth. We're seeing a lot of that in the headlines as well from folks that we've talked to, particularly when more geographies were on a more strict lockdown. A practice's ability to provide treatment was highly correlated with their integration of telehealth or lack of. That's of course aside from emergency procedures. So now that telehealth has become more of the norm than the exception for a number of providers, and at BMO we saw a good example of this in the LifeStance deal, where we just advised on the buy side for TPG Capital, and that was an asset that they just acquired in the mid-April timeframe. So pre-COVID, telehealth was just a small part of the business for LifeStance, but now when you go to the company website, you're immediately directed to different telehealth providers depending on state. So it's been a pretty meaningful change for them. We've talked to other mental health providers who have shifted to where they're now essentially at 100% telehealth with no immediate plans to return to in-person sessions. But that said, in some cases, it's still that way due to government order, like we have here in Minnesota. So from what we're hearing, the response from psychologists and therapists has been overwhelmingly positive for telehealth, and it kind of feels like it's going to be the way of the future, giving greater accessibility to providers and patients who no longer need to travel or deal with traffic to make their appointments. So from folks we've talked to, a hybrid of this will likely be the way forward, just kind of based on client specific needs and just kind of safety from a broader social distancing perspective. So those are a couple areas that we're seeing more strength.
And thanks, great answer. At Clearview as well in our fund, we're using telemedicine and telehealth in some of our portfolio companies as the environment has changed. And that has its own challenges too with certain reimbursements, but that's how you get treatment and care to the patient and to the client. So that's great news. Ken, can you share some perspective on some of the sectors that you feel are strong and valuable going forward?
Yeah, sure. Well, I'd like to just jump in on the behavioral real quick as well, because that's as well as telehealth, because those are real focuses of Ziegler. We've actually just put out our third white paper on telehealth. So if anyone wants to reach out, happy to share that. Obviously, these are areas that were growing, before COVID, and there was a nexus with behavioral and telehealth, because it was, one of the spaces where it was easier to make the transition to telehealth compared to some other areas. And we've seen that on one deal we're working on with an autism provider. They were able to, in COVID, quickly transition their patients over and didn't really see a loss of volumes, whereas other providers who weren't able to make that transition, competitors, have not done as well. So it's been very important during COVID. And then, one deal that was interesting, United bought Able2 for 10x revenue, $470 million deal, focused on that behavioral telehealth space. So, we're very active in it, and just the amount of interest in these spaces has just picked up to a very high level, and obviously telehealth is impacting other spaces too, quite a bit. But behavioral's been certainly one of them. But yeah, I would like to. Getting back to your question, just an area I've focused on, our team in Minneapolis focused on quite a bit is home and community-based services, particularly home health, hospice, and actually we did a really interesting deal recently, which is a physician house calls deal, actually a company named Physician House Calls, which we sold to Council Capital, and very similar themes of care in the home, but obviously with physicians and nurse practitioners as opposed to home healthcare providers, but a lot of themes, are very similar in that people really want to manage the highest risk patients. These were, sort of the sickest of the sick, and manage them, keep them out of the hospital, which are themes, we see across healthcare. Obviously, treating patients in the lowest cost setting, but we think, broadly speaking, in home health and hospice, the lack of elective surgeries has reduced volumes in the last couple of months with COVID, but they've actually started to come back somewhat, and some very strong trends of Amedisys and LHC on the home health side just released their Q1 earnings, and actually the stock prices did very well in the aftermath of those releases. Their stock prices overall are not overly affected, still trading in very, very good ranges. And Amedisys just did a very attractive deal, a good sized deal for AseraCare in the hospice space, which is traded for 2x revenue. So definitely seeing a lot of robust activity. We have robust couple home health deals that will be coming to market pretty soon. So definitely a space where we think the overall trends are that of move to care within the home are just going to continue in the COVID environment. That actually probably promotes that more. But thanks.
Great, thanks, Ken. Dan Schultz from Webster, given you have an ownership position in home health services companies, be interested in your perspective, sectors that you see strengthen?
Yeah, so, in any environment like this, you want to try to find ways to treat patients without having them have to go to a physical location. So when it comes to home health and hospice, you're seeing more of those opportunities where with protective care, people are able to get somebody to come to their house to, help them with whatever service they need. I think what we've really seen in the last couple of months too is that this telemedicine has exponentially shifted forward, where we probably wouldn't be talking about this today unless COVID had actually happened. And we've seen that in our behavioral health clients, some of our physician practice management companies, where we're seeing more of these patient visits done virtually by telemedicine rather than them actually physically coming into a doctor's office or a facility. So that's one area that we've seen an uptick. We've also closed a deal during this whole COVID environment. We acquired a GI practice in the Southeast. And with that deal kind of being under LOI prior to COVID and then closing post-COVID, numbers initially for, April and May are going to be down a little bit, but we expect that it's just going to be a timing period, and you're going to see more of those services provided in June, July, and August, because what's going to happen is those are still the essential services that need to be done, but it's just going to be a delay. We're also seeing that with our retina practice that we acquired. It's just a delay in when people are actually going to have retina surgery. So what we're seeing a lot is that there's some shifting in the environment. They're shifting how we're serving patients within our facilities, and our companies are adjusting to that. We have a travel nurse business as well that's doing very, very well right now, and that business is going to continue to perform because nurses are in high demand, and it's an area that but we see a lot of success going forward.
Great. Yeah, we recently sold our travel nurse staffing business last year. It was a good exit, and there is a lot of demand there. We're additionally seeing a lot of strong census numbers coming in our behavioral health businesses, although other businesses that are center-based are having a bit of a challenge given different regulations in different states on what centers can stay open or can't stay open. We believe that's a short-term phenomenon, but still you have to navigate through that and use telemedicine as best you can to take care of those patients. Moving on to the next question, and this is for Dan Schultz at Webster. Dan, how do you position Webster to work with investment bankers and create a pipeline of transaction opportunities for the fund, whether platforms, add-ons, et cetera, in this current environment that we have that's somewhat restrictive?
Yeah, so I would say that with any acquisition of ours, we make sure that we have a strategy up front of what our acquisition strategy is going to look like. How do we fill the pipeline with opportunities, and how can we make that successful? So, for example, this recent GI deal that we did, we did buy that company through a process that a bank was running, but we also had a list of other potential add-ons that we were entertaining from our own outreach, and then some other intermediaries within the market that had relationships with these companies. So what we really look to is we look to have continuous dialogue with investment banks, making sure they know where we're investing, what we're looking at currently, areas where we want to invest. For example, women's health is an area that we would like to get into. So we own a fertility business, but we want to get into the OBGYN sector. So making sure that intermediaries are aware of that, but then also working with them to figure out, okay, if the target is too small for a traditional process, is there a possibility for us to pay a buy side fee if there's a deal that's smaller and you're not going to bring it to a broader market? Or are you seeing activity in certain sectors? Because healthcare services is a great example of how you can acquire a platform company and add a bunch of add-ons, because you can add a service line, you can add another office, you can really expand in a lot of great ways. So that's an area we're looking at. So right now, we're seeing a little bit slower deal flow than we would have seen a year ago. The expectation that is going to pick up as people kind of get an understanding of COVID and how the impact is going to be in the short term. So we're anticipating that, and I would say this week we actually did see more deals than we have in the last couple of weeks. So that's a good that's a good sign. The other thing too to look at too is when we look at companies and opportunities, this is a great time for us too, because there's some owners that no longer want to be managing their practices, and this is a great opportunity for them to potentially sell to another private equity firm, another strategic buyer, or somebody else, just to make sure that they can become part of a larger practice, not have to worry about all the regulations, not have to worry about what are you going to do with cash when you've got a dip in visits, or you've got a dip in business. So that's another area that we've seen is more proactively companies are coming to us and saying, hey, we're interested in becoming a part of a bigger platform, so we don't have to have the worry of having to manage this business day to day.
Great, thank you. I guess the next question is for the investment bankers on the panel. Dan, Ken, what are investment bankers proactively doing to keep, one, in touch with clients about their prospects for sale processes, and two, for capital needs, refinancings, raises, potentially acquisition debt or add-ons. Ken?
Sure. Yeah, actually, it's interesting you guys brought up on nurse staffing. We happen to have a very interesting nurse staffing business, does a lot of travel as well as per diem. And we were in market with it right when COVID hit, and very, very strong interest for the business, but we hadn't gotten sort of post signed LOI. We were still sort of having meetings with buyers, and now we switched to having those meetings virtually. But there's sort of an idea that we can't really get to a signed LOI until people are willing to travel and get in the same room. So it's actually been interesting, because in some ways I feel like we can do a more, when you have one management meeting and it's 4 or 5 hours, people probably, halfway through, lose sight of the agenda or get very focused on 1 or 2 things. But if you have the ability to sort of over the period of weeks and months, really focus on the business, I feel like it's probably a more deeper dive where you're focused on the pure analytics of the diligence versus just what was said in one management meeting. So we've sort of just transitioned that process, but to make it all work, at some point we have to get back and travel and be able to have that final sit down. People need to be able to shake hands and really feel like they know the person. So I feel like it's been a period of kind of stay interested. Buyers are staying interested in the companies they like, but it just looks very different if somehow we're not able to switch to travel within some kind of reasonable period. And then new clients, same thing. I think processes, people are happy to have a 4 to 6 week stretch where in the beginning of a process where you're asking questions virtually, but at some point, again, it doesn't make sense to launch a process and not have any window into when people will be able to get in front of you. So that's kind of the challenges we're dealing with, and we've been working around it. But I think we all want to get back on the road at some point.
Yeah, as much as sometimes we fret about being on the road all the time, now we're really missing it and getting in front of the management teams and really getting to know the business, especially for groups like Webster and Clearview Capital and other private equity groups. When we're buying a company, typically, 3, 5, 7 year holds in some instances, you need to know who you're in partnership with and get to know them over that period of time. And that's what's a little bit lacking going forward right now until that all clears up and settles out. Dan McIntosh, same question to you. Curious of your perspective here.
Yeah, really a lot of similar themes on the M&A side. We're having quite a few conversations just around, clients, their overall business demand, the changes that they've needed to make, and then just kind of around what timing could look like for prospective sales processes, giving all the different variables in play here. Quite frankly, their main focus has been on the performance of their business. But we've also had a lot of conversations around what different adjustments could start to look like, both on the revenue and the expense side. So it could be around business interruptions, could be around one-time demand increases or decreases, could be around on the expense side on non-recurring expenses related to the work from home, for example, overtime rates, or else just mitigations for supply chain risks or protections. So it's been pretty steady.
Okay, great. Next question for Dan Schultz from Webster. Dan, could you tell us about the lending environment and how it's treating healthcare service companies, potentially ones you own, and the longer term view, favorableness of the sector to lenders, and if you're pursuing any supplementary investment strategies to mitigate this lending capital markets that we have today?
Yeah, so that's a good question. So, having spoke about a deal that we completed during COVID, we needed to make some decisions about the lending environment because there was uncertainty, and there still is some uncertainty in the environment. You're seeing a lot more of your traditional commercial lenders that are being a little bit more conservative, waiting to see how numbers are going to kind of pan out during this period. BDCs are in that same boat, that they might be a little bit more aggressive in terms of the time frame of what they're looking to evaluate in order for an investment to be made. What you're really seeing though is that the valuation of these businesses, you have to figure out how do you pay for the value. Is there going to be a retrade? Is there going to be some sort of adjustment because of COVID. And what we're seeing is that the lending market is not necessarily open for business, but there are still some deals that can get done. And those are deals that haven't been affected by COVID. So in healthcare services, I mean, you're seeing a lot of those deals that have some impact, but deals are still getting done. The other path that you can kind of follow if you're wanting to get a deal done is to do all equity. And we've seen that with some deals within our current pipeline, is that we'll do all equity now and we'll refinance the deal later where we can get some debt on that deal. So we can still get deals done. It's not going to be the traditional, lending and equity, but it's a way for us to get good companies in the portfolio now during this time, and then refinance the debt later.
So on an all equity controlled buyout deal, you would have to have a fairly high level of confidence that, one, things will be fine in the future, and two, that it's a financeable business, and potentially already have some looks from lenders, but they're just not pulling the trigger now or not pulling the trigger fast enough?
Yeah, I think that's exactly it. So you're going to want to make sure that you believe in that business model. And a lot of the businesses that we look at, for example, we're looking at a deal right now, and volume is down in the last 2 months, but we expect that the volume in the next 6 months is going to increase more than what budget was, because it's going to make up for those last 2 months. So you do have to have some idea of the industry, which we focus a lot on the specific subsectors within healthcare services. So our investment teams are very, very well aware of those micro macro trends. And then we're also looking at what's it going to be in the future, because if we do all equity now, we have to be sure that we're going to be able to refinance that debt later. So the company needs to continue to perform post-COVID with our entire equity investment.
Yes, good, very interesting. The next question, we'll go back to you, Dan Schultz. Tell us about your typical hold times for your portfolio investments, and how has the current pandemic capital market situation impacted those times? And if there's any examples you want to cite of companies that might go to market faster or stay in the portfolio longer?
Yeah, so that's a good question, because obviously when the initial kind of COVID happened, people weren't really understanding what was going to happen. Nobody really knew how long this was going to last. So for our fund, deals that normally we would have thought we would have exited this year may be delayed as we get a better understanding on COVID. We also look at performance. Traditionally, we're looking at a 3 to 5 year time horizon for most of our opportunities. Some of those deals are a little bit longer. Some of them we've exited in a shorter perspective. But the other thing to kind of keep in mind with this whole situation is even from the buying and selling. So we're buying, but Ken and Dan are selling companies. Is how are you valuing these businesses right now? And that's sort of something that I think the market is going to have to kind of understand and adjust to COVID. So if a business is doing really, really well with COVID, are you going to give a decrease post-COVID because business is going to come back down to more sort of streamlined levels? Or for companies that aren't performing, are you going to have an adjustment for them to come back to mainline? So it'll be interesting to see what happens with the valuations of these businesses, where the multiples come into play. But any deal that we would have marketed this year is probably going to be pushed off until 2021, because we need a little bit more clarity on what's going to happen and where the market might be. Now, sectors that wouldn't be focused or wouldn't be hurt by COVID may be prime candidates for exits in this current environment, as well as you can look and see and make sure that there's going to be lending and that buyers are willing to buy those businesses.
Yeah, I agree with some of our portfolio companies, especially in healthcare services, that we were planning on potentially bringing to market this year. I would say 2021 feels like a better year. We'll have this year behind us. Maybe in some cases, there'll be an add back that the market accepts in general, or we'll find some outperformance due to being able to do some acquisitions and push the growth on certain healthcare assets we own. I would say fresh eyes in 2021 might be a better way to look at some of these companies more realistically and their future growth prospects, which I think will be a benefit to all of us.
Yeah, that's exactly right.
Ken and Dan McIntosh, similar to you question, but client companies that you may sell, whether they're PEG-owned or not, how is this pandemic impacting their hold times or exit strategies? I guess in terms of, if it's a private equity seller, what kind of feedback are they giving you on hold times and length of keeping companies around longer? Or if it's not private equity owned, how are other companies looking at exits and whether they're pulling in the reins or they want to go to market because they feel their business is standing very well? Ken, Dan, either.
Sure, happy to hop in. Yeah, I mean, those are some of the issues we're obviously dealing with some of our clients. Fortunately, that nurse staffing business is doing record volumes because they've been able to place nurses into ERs in the hospital. So that's probably, not most businesses right now. On the home health side, I think I mentioned volumes are down. We're actually getting a lot of incoming calls from private equity firms, both to our clients and to us, demonstrating, real interest in investing in the home health space. But clearly, yeah, we think there should be, if we're taking a business to market, we think there should clearly be an adjustment for, this time period, which is sort of unprecedented. But in order to make that work, I think buyers are going to need to see that, at least see that the trend is coming back. So I think it's really all just kind of a timing perspective. We're not going to accept, bargain prices, or else it would just make sense to wait unless somehow your business can't wait. But buyers are going to want to feel confidence that the environment has at least turned in order to provide adjustments during this stretch, which will be necessary to really get a transactable price, I think.
Yeah. So I would say similar on our front. I think a lot of times it's been more, frankly, buyer focused, where we've seen quite a bit more activity on the strategic side rather than the PE side. But that said, among strategics on the healthcare front, like we do have cases where, in some cases a strategic will be in the manufacturing of ventilators, for example. So they're going to be putting a lot of things on hold as they focus on upping their production there, kind of worldwide. So for all the right reasons. But, I think on the private equity side, we'd expect things to kind of pick back up there once the funding picture becomes more clear.
One question we've had is, how far off has COVID likely pushed exits for portfolio companies? I think we've answered that. I'll give my answer. I think on some exits, we've added a couple years, but that might be a net positive because we're going to use this time to do further add-on acquisitions. So, especially in the healthcare sector space. So next question, focused on Dan from Webster on this. Are there any sectors or meaningful opportunities in healthcare services that you're pursuing aggressively now that are rising from the COVID crisis specifically? Anything under LOI? I think you mentioned GI, but any other sectors that you want to target given that the last 3 months the world's changed a bit?
Yeah, so let me kind of put things in perspective. So from our perspective, prior to COVID, we had about 40 to 50 short-term pipelines within healthcare services that were on our list for bankers bringing to market. A lot of those deals had kind of been pushed off until the end of the summer, early fall, just to see what happened. So we kind of internally had to make a decision on where are we going to put resources then, because we still have capital in our fund and we want to invest. So one of those deals that we did get done was GI. We've also got a pathology deal that's under LOI. And so timing of close should be in the next month and a half or so. So that's one of them. We've also focused very heavily on our portfolio company. So within behavioral health, we've got autism, we have opioids and addiction treatment, and those are areas that we're trying to focus on add-ons because we believe that we can put capital to work directly with those businesses. Home health and hospice, another area. Healthcare staffing is another area. Within the physician practice management space, we have a broad services line there, but now we're looking for women's health, as I mentioned earlier. And really the focus for this is we don't expect that we're going to see a lot of platform acquisitions in the next 2 to 3 months. So our efforts are going to be more on add-ons and potentially entering new markets that we don't have, which is it's good and bad because it's tough because, businesses like telemedicine or healthcare staffing are focused on the demand they have right now, and they might not be ready for an acquisition at this point and may need some time to let the dust settle before they do something.
Yes, it's interesting. Both Webster and Clearview have platform companies both in the opioid addiction treatment space, and we recently completed an add-on acquisition to our company that was started before the pandemic crisis, but as we went through the crisis, it became more imperative for both us as a buyer and the seller to get the transaction closed. So those are very strong spaces with growing census.
Just curious question to both of you. Are you either proactively reaching out to maybe more financially troubled add-ons opportunistically, or are they even getting people reaching out to you saying hey, I really need a bit of a lifeline here? Or I'm just kind of curious.
Yeah, I'll say that people are reaching out to us with I'll say challenged add-on acquisitions for our healthcare services companies, although they might not consider those companies to be challenged, but we would from a liquidity perspective and others' perspectives, just so we can see that they do need to do a transaction, but that might not be their choice words because they're the owners. But yes, we're definitely seeing that. Dan, any thoughts?
Yeah, so I mean, we are seeing some of those opportunities, but we've also too, on the investment side, identified targets that we want to acquire as add-ons. So we've been doing direct outreach for those opportunities. So it's sort of a combination of both. For some of the behavioral health, we are seeing more of those opportunities that need some help in terms of capital or in terms of being part of a broader business model. But then there's other businesses that are still performing that we're doing direct outreach because we've identified that we think they would be good additions to our current portfolio.
Yeah, and it's interesting on the add-on acquisition side. I especially like doing add-on acquisitions. I like looking for them and coming up with them. At the same time, a couple of our behavioral assets or platforms are now heavily investing in de novo growth. Given they've done a fair amount of add-on acquisitions over the past several years, now they're seeing an opportunity to invest capital and get outsized returns versus acquiring that same level of revenue growth. So cuts both ways. So we're looking from both perspectives now. And Ken, Dan, are there any specific sectors or businesses you're aggressively pursuing for new mandates without giving them away, just things that you're going after, you're pitching hard, whether it's virtually or however?
So I can just say from the BMO front, we're really just staying focused on our normal areas that we have been. So we're anticipating plenty of activity there, got a lot going on, whether it's through strong demand like we're seeing on the behavioral side, or else just given kind of consolidation opportunities continuing on the retail and consumer directed side. So really not a lot of change from that perspective.
Ken, any thoughts?
Yeah, I'd say it's more just prioritizing of the areas we focus on. It makes more sense maybe to work on those that aren't as challenged. Obviously we've seen on the patient practice management front, with elective surgeries and also primary care and dental, things like that, have slowed down so much that other than a forced sale, you're not going to have someone really in good shape to go to market right now. So obviously, yeah, just focus on the areas that maybe aren't quite as negatively affected.
Great, thank you. That covers our more specific questions. However, one last broad question. I think we still have a few more minutes. How is pent-up demand for healthcare services going to be handled once we get to a more stable and normalized situation? I won't define when that is stable or normalized, but when you mention, gastrointestinal or women's health or dental or derm or vision, where there's a fair amount of elective, how do we handle the inflow of business when things start loosening up in a couple months?
Yeah, so I would say that from a portfolio company perspective, and these are conversations that we've been having at the portfolio level, is once states kind of return to some normalcy, you're going to see that that more resources are going to be brought into the facility. So if your physicians are typically working 3 days a week, they might work 4 days a week, they might work 4.5 days a week. So we believe that all of that sort of demand is just going to be a timing perspective over the next 6 months once we kind of hit that normalcy and things are open for business. The one thing to also keep in mind, though, is as people return to these facilities, we have to find ways to make sure that the environment is clean, that patients are taken care of, that their safety is a priority. So that's going to take a little bit longer to figure out as people start to come back. But you're also going to have some patient confidence that needs to get to a point where they know that they can come into your facility and not have any issues either. So for us, the broad perspective for us is that it's just going to be a timing issue, and that it'll either stretch out into Q4, Q3, Q4 of 2020, or even potentially into Q1 of 2021.
Yeah, I was going to say, I think it's really hard to answer some of these timing things, because I think, like Dan was just mentioning, each person, it's not just like the government's going to flip the switch and everyone's going to just go back like everything was. I mean, each person is going to individually kind of assess how much they need this procedure and how scared they are of going out in the public. And I mean, it's just going to be an individual component that's obviously hard to predict. I do think on the deal side, it'll be an interesting thing in that, PE firms obviously, have raised capital and have capital they want to put to use, and maybe won't see quite the same volume of sort of new platforms as we discussed. But, as good platforms do come to market, maybe the supply of those platform opportunities won't be as high, but therefore, the prices might not be, as impacted, because there won't be as many options to bid on. At least it'll be one possible perspective, but I guess that remains to be seen.
Yeah, I'd say a good company that even showed some softness this year but didn't crater is going to be in demand. It's going to be considered a good business. Well, if there's no other questions, and I don't think I see any other Q&A questions, maybe just some final thoughts. In summary, we have learned that no area of healthcare services is left unimpacted by COVID-19. However, there are substantial differences across subsectors regarding the level of that impact and the responses to alleviate and grow that. Thank you very much, Dan from BMO, Ken from Ziegler, and Dan from Webster, for participating and sharing your unique healthcare industry insights. Very much appreciate it, and look forward to further discussions down the road.
Thank you, Larry, and
Thanks,
thank
Larry.
you to our panelists. Appreciate your contributions here. And I think it's actually good that we ended a little early, because I think most of you are participating in our Deal Connect directly following. So what you'll want to do is log out of here and log into the separate link that my colleague Terrence Winters sent to you all. Again, I want to thank you, panelists, of course, our sponsors. As you can see on the screen here, we have a few more webinars coming up. We're doing at least one a week. So next week we have a couple coming up. Please look out for more information, and we'll see you next time. Thank you all.
Thank you.
Bye-bye.
Thank you.
Thank you.